Hi, how's it going everyone? My name is Hank and it's been a real rough start to the year of 2022 for the stock market after a relatively calm 2021 where the market pretty much has just gone up most of the time with at most a 5% drop. The S&P 500 was down by more than 10% in January of 2022 already. Now, inflation in the US is up to around 7%, which is a 40-year high for the US. Now, in an attempt to combat inflation, the US Federal Reserve is projected to increase the interest rate around 3 times this year to 0.75% to 1% by the end of the year 2022. Analysts also expect 3 more potential rate hikes in 2023 as well. Not only that, the crypto market is also crashing. Bitcoin is down, Ethereum is down, pretty much every single altcoins out there is also down. With all sorts of bad news piling in, many people are wondering when is the end to all of this? So there's 3 main questions here. Now, first of all, how does the market respond to all the rate increases? Secondly, what happens to the market after a relatively calm year like the year 2021 that we just had? And finally, when would the market actually recover? According to a recent article from Bloomberg, now since the 1950s, there's been 12 rate hike cycles. On average, the market has increased at an average rate of 9% during those cycles. Now, out of the 12 cycles, only 1 cycle posted a negative return. Now, this shows that you shouldn't be afraid of the rate increase cycles. And 9 times out of 10, the market posts a positive return during those times. The recent sell-off is not something that's unusual when you look at the market historically. In fact, if anything, it's unusual how calm the market has been for all of 2021, and people seem to have gotten quite used to it. So whenever there's a sudden dip, people start to panic a little bit. There has not been a significant drop of 5% or more for the entire year of 2021. Now, dating back to the 1950s, there's only around 10 such years with such a non-eventful market, with the most recent one before the 2021 is the 2017. So back in 2017, the market simply rose up at a very, very steady pace over the entire year. And then in 2018 is when we got off to a very rocky start to the market with a couple of sell-offs in the first couple of months and ending with the crash of December of 2018. That was where the market dropped almost 20%. Now, I know 2018 might feel like a long time ago, but it really wasn't that long ago that all of that has happened. In fact, if we look at what happens to the market a year after a relatively calm year, the average pullback of the S&P 500 during those years that come after the calm year, the average pullback is around 13% during the year. But the average annual return by the end of those years is still a positive 7%. This means that there is a good chance that the market will recover the 13% loss in January and still post a slightly positive return if past results are anything to go by. So when would this turbulent market most likely to end? So another factor that may influence the market this year is the US midterm elections. Historically, the market averaged a 17% pullback across the 18 midterm election years from the 1950s. However, the last 3 months of the midterm year and the first half of the year after, the market has seen an average return of 32%. So what does this all mean? First off, if we take averages of all of these data, it suggests that in the first half of 2022, the market could be quite volatile with pullbacks of 13% or more. However, from a historic standpoint, the last quarter of 2022 could see some significant gains in the market once the midterm election results are stabilized. Secondly, the data suggests that we should not be afraid of rate hikes from the Fed. Now, while increasing interest rates may hurt the valuation of a lot of the big tech companies, historically, the market has performed very well during those periods of time. To put it simply, this is actually a very good opportunity to buy some really good companies at a reasonable discount. People have been complaining for years that companies are completely overvalued, and you should definitely take this as an opportunity to buy the dip when it actually represents itself. Some of the good companies that you could potentially look into include Nvidia, Microsoft, Google, amongst many others. If we look at the chart for Nvidia, a very, very solid chip-making company, its price is down from its high in end of November, around $30 per share, all the way down to around $223 per share. So they are down by more than 30% at its highest or even lowest amount. Another very good company, Google or Alphabet, had its highs in November of last year of around $3,000 per share for Google, and they were down by around 15% to around $2,500 per share. Another very solid company is Microsoft. Microsoft had its highs around December of last year, and they were down at earlier January by about 15%. Now, since then, it's bounced back a little bit, but it's still down by a significant amount. And like mentioned in other news, Microsoft has recently purchased Activision Blizzard, so they are slated to gain even bigger. Thanks for watching, and I'll see you next time.